Hey, this is Skyler Weinand with Regan Capital. Today we're going to talk about what we call the Fed pivot, which is actually when the Fed started dropping rates on September 18th. This chart we're looking at right now is the day before they dropped rates. And if we look at the yellow curve here, curve was very inverted. You were getting almost 5% in cash, but you were only getting about 3.5% in the belly of the curve. So many folks, we had a ton of conversations with folks that wanted to go long duration in the weeks preceding that first Fed cut. They felt, oh, the Fed's going to cut interest rates. Rates are going to drop. I've seen this playbook before. Similarly, mortgage investors and folks that wanted to take out a mortgage were waiting for the Fed to cut for rates to drop. Lo and behold, now many folks realize that the Fed only controls the front end of the curve. So what's occurred is after 100 basis points of Fed cuts, rates on the front end of the curve have dropped about 60 basis points, but the belly and the long end of the curve have gone up roughly 100 basis points. This has created about 4% in losses for traditional fixed income investors from September 17th to today. So this is really, really important when we talk about where we want to be on the curve in risk reward. So back then, if you look at this yellow part of the curve, you could have gone out and bought 3.5% yields, which 4 to 5 year duration. That's lost 4 to 5%, whereas the front end of the curve has actually made about a point in that time frame. Okay, so with an inverted curve, and we've had an inverted curve, we had an inverted curve for about 2.5 years. As we've been talking about repeatedly, the wind is at your front, so to speak, going out and owning fixed rate long duration paper. When the curve is shaped like this, you want to stay short and actually own floating rate paper. And you won't hear this from many folks because most indices are 100% fixed rate, and floating rate composes only about 5% of the outstanding $55 trillion fixed income universe. Okay? Now, where we stand today, you're making about 430 on the front end. You're making a reasonable, 4.5, 470 out in 5s and 10s, but we're not there yet. We're not there at a point where you really do want to go out and own duration unless you have some type of mandate. Okay. I'm going to bring up one other Bloomberg chart here, which is agency mortgage-backed current coupon spreads, which in September were about 120. Today, they're about 135. Okay. There are some folks out there that said go out and buy mortgages because they're really cheap, but that spread is based off of this part of the curve. So you have to pay attention to the curve and where you're investing, in addition to at what yield you're investing, because that's going to determine your total return. So I'm going to bring up a couple sheets here. And first of all, let's talk about the current curve. Okay. And here we have the front end at 4.25 roughly. This is live data. All we're bringing in here is live data, not futures. And we look at, well, what happens if you do roll down slightly by owning these nodes of the curve? What's your yield change? What type of capital gains will you receive? And what total return will you get? You could see here, okay, you're going to get 450, 460. You're going to get roughly what you invest at over the next year. Back in 2004, roughly 20 years ago, yields were much lower. Yields were around a point lower than we're today. But based on the shape of the curve back in 2004, and let's go to 09, 17, 2004. Based on the shape of the curve and the ability to roll down much larger margins, you would have actually made more money investing at a point lower yield 20 years ago. And we look at pre-Fed cut, there were plenty of very large fixed income investors telling folks to go out and lock in 3.5% yields. Okay. We're actually telling you to lock in inferior total returns. Okay. So if we look at where futures are today, or where the market is saying we're going to go. So this is 1 year current yields, and this is futures. As you can see, the market's forecasting rates to go up 15 to 20 basis points kind of across the curve, which implies a market value loss in inferior total return going out the curve. So as I say in a lot of my messages, memories are short and stay short, my friends. It's still time to stay relatively short. okay, i.e. 2 years in. Okay. So then I'm going to bring up a couple other things. Let's look at agency mortgage backs. Okay, this is the coupon stack. This is the outstanding market. And many folks have been buying agency mortgage backs. They've been buying index funds. The indexes are made up of their market weighted index, and they're made up of primarily Fannie 2 and 3s. And you can see the yield here is about 430. That's okay. You're getting maybe 60 spread over that roughly 7 year part of the curve. It's okay. Okay. But you can go out and you can buy 550, almost 6% return yields based on a lower risk part of the curve, the 5, 4, 3 year part of the curve, which will imply a much higher yield. You're picking up roughly 50 basis points. So let's do some math real quick before I let you go. Let's look at where we were in cash. Let's look at where 5 years were. Okay. On September 17th to today, cash has dropped 60 basis points. The 5 year has gone up roughly 100 basis points. Okay. Back then, you could buy Fannie 5.5s at 122 over. That spread is increased to 135. But what's important here is yields. Okay. Back then, if you were investing in those Fannie 5.5s, you were actually losing 24 basis points relative to cash. Okay. And given the backup, you've lost much more than that since then. You've lost a couple percent. And whereas today you can pick up almost a 6% yield. You could pick up 151 basis points relative to cash today in Fannie 5.5s. Back then you were getting 95 over. Today you're getting 120 over. And this is Fannie 7% cap rate, floating rate paper. You were getting 585 back then. Today you're still getting 550. Okay, so spreads have widened about 25 basis points, but you're sitting in much lower duration than you would here. Here you're sitting in roughly about a half-year duration. Here you're sitting in roughly 5 year duration. So if we talk about yield per unit of duration, we're getting roughly 11x. Okay, let me do that. Whereas here, you're getting 1.1x. So it still makes sense to stay relatively short, but you're still getting rewarded here staying short in the curve. Again, this is Skyler with Regan. I appreciate your time.